I really can't tell you guys what a special speaker that we have out here tonight. And I don't mean to oversell him, because that's absolutely not the truth. But the reality is that Mr. Greg Willett actually speaks at the very tip top of the apartment events out there, period. One of the biggest events that everybody goes to is every year is the, oh gosh, now I'm escaping.
National Multifamily Housing Conference.
Thank you. NMHC, National Multifamily Housing Conference. And Greg is one of the featured speakers. When I say that people listen to Greg, I'm saying that the largest investment firms that are doing multifamily, the largest banks that are doing multifamily and lending on multifamily, these guys actually pay very close attention to what Mr. Willett is talking about. And by the way, his firm, RealPage Analytics, if you guys are ever interested, if I can plug his company, if you guys want to know everything there is to know about data analytics behind any market, any sort of trend that you might be wondering about in multifamily, RealPage Analytics is the place that a lot of us go to find that information. And so it's a real pleasure, and I'm really honored that Greg would come out here. By the way, again, from Texas, would come out here to the Bay Area to spend some time with you guys. And I want to welcome Greg to the stage and really thank him for coming. And this is a big deal, so we appreciate you coming out here, Greg. Come on up.
All right.
He is the man.
That is really overselling in a big way. And I'll point out, it really made me nervous as all the hands that went up on who listens to the podcast, because I did one recently. And number one, I don't know if I have new material. And number two, I don't know if I'm going to contradict myself or not here tonight. Let me give you a little bit more background about RealPage, which is a technology and analytics company that really focuses, we do a little bit on commercial space and vacation rentals, but really our focus is in the apartment sector. And we have about 70 different technology products that are used to operate and evaluate investment in the apartment space, and key technologies would be basic property management software, resident background screening. The group that I work in does revenue management, which is statistically modeling rent prices, changing them every single day, as well as benchmarking of what's going on in the marketplace. We have resident services and marketing areas. A lot of different things go on at RealPage. And just some background there, RealPage hits 21 years in business this year. I've been there for 20 of them. When I came in, RealPage was 400 people, really a tech startup. We made it to the point that we were able to go public in 2010. At this point, we are about 6,000 people worldwide. We will hit $1 billion on annual revenue this year. And our market cap is between 5 and 6 billion. So it's been an interesting ride and a lot of opportunity there. And as mentioned, these technology products have a lot of data that you can mine out of them. And so I really get a snapshot of the US apartment market every single night. I don't go in there and study it every day, but we are refreshing data constantly as we go through this. And so I appreciate the opportunity to join you today. I'm going to talk about a little bit about what we see going on, big picture, and some of the key trends, and sort of giving away our perspective on it is, I did call it exploring late cycle opportunities. So, and when we say late cycle, that doesn't mean that we're about to go off the edge of the cliff in the economy and the real estate market, but it does mean that we're probably closer to the next recession than we are to the last one, and we are past peak performance in the cycle. And so, JC, it was interesting to hear you talk about, I mean, it is still a cycle, and there will be a downturn, and you have to view this as a long-term investment and be ready to deal with the downturn whenever that occurs. So a couple of things that I really want to talk about include what's happening on the demand front and some of the drivers of demand for apartments. And certainly this has been a fantastic cycle for apartment demand. The numbers are still really strong at this point. But obviously at some point in the near term, we're going to get a little bit of a bump in the road because there should be some sort of economic slowdown. Giving you perspective here, I'm going to talk about national numbers, and when we talk about the U.S. as a whole, we are focusing on the 150 largest metros across the country, and I'm specifically talking about market rate products. So we're taking out anything that's designated affordable housing and student housing and seniors housing and all the variations you can have there. So throughout recent years, demand for apartments has run right around 300,000 units in these top 150 metros, and a little bit of fluctuation from one year to another, but fairly consistent. And you can see we've updated the data through first quarter of this year, and we were again right at 300,000 units. Very substantial demand, but I will point out as you look at the tail end of that chart there, go back a couple of quarters to fall of 2018, and we were doing a little bit better at that point. And so there is normal seasonality, and usually 80% or so of demand for apartments across the country registers in what is the prime leasing season in second and third quarters, and only 15 to 20% of demand shows up in these cold weather months. So there is that normal seasonality. But if you look at the cold weather months, last quarter of 2018, first quarter of 2019, demand was even a little bit weaker than what we had seen recently. And so there's the question of, was that just a blip in the data, or is it some signal of what lies ahead? I've been talking to our customers a lot in the last few days since we've now made it through April. That should be the month that demand really starts to kick in again. And frankly, in these conversations, I'm getting mixed signals in the answers. And I talked to a client yesterday, and he said the first 4 months of this year was actually the strongest first 4 months of any year he's experienced in this cycle. I talked to a couple of clients today, and I was visiting folks out here and taking the opportunity to talk to them. One of the two companies I talked to today, one of them said, it was okay, but not great. And then the other one said that it was a little bit of a struggle. So again, different experiences from different clients. And I think what stood out for me as I'm having these conversations is a little bit of market segmentation. And I'm getting the folks who specialize in middle market to bottom end product seem a little bit more pleased with the results they're having than the people who are concentrating on luxury apartments. So let's talk about what is influencing the demand trends, and starting with the overall economy. And to me, the number that really tells you the most is just what are we doing on job production on a monthly basis. And so for the first 4 months of 2019, on average, the U.S. has added 205,000 jobs. That is a very healthy number. Similar, a little bit down from what we did in 2018, but still very solid and good relative to what we've done a little bit earlier in this cycle. But something that is very different in recent months versus what we have seen a little bit earlier, it's amazingly inconsistent from one month to another. In that 4-month period, we had a couple months where job production was at 250 to 300,000 jobs. One that was a month that was a little bit less than that, and 1 month that was you barely added any jobs at all. And so that does tend to make businesses a little bit cautious, and it does tend to make consumers a little bit cautious as well. And so overall numbers are great. And I'll point out, we came into this year and government was in shutdown, and that made people nervous as well. So the recent numbers have been good, but not spectacular for overall performance of the economy. And certainly something that we're now starting to experience in the economy is just shortage of workers in a lot of industry. And you can see that orange line is the unemployment rate. And what's considered really full employment is 4 to 4.5%, and we're well under that at this point for the nation as a whole. And so that can mean that, and we have been in a situation already for a full year where the number of available job openings well exceeds the number of people who don't have a job and are out there looking for a job. So in a lot of industries, it's tough to do hiring. That's, as I talk to folks we do business with, and just looking at our own situation, it's really hard to hire in the tech sector at this point all across the country. One client I talked to today, it's not just skilled labor, highly skilled labor. He told me what he just paid to hire a experienced maintenance supervisor for their portfolio. Wow, it was a stunning number to get that hire done. And so that reflects what's happening in the dark blue line there. We are seeing an uptick in wage growth as worker shortages become more pronounced. And there is, on the apartment side, there is a good storyline there in that we went through early in this cycle, rents were going up much faster than incomes were going up. But we have now seen the incomes get a little bit stronger, which then gives, in a lot of cases, a little bit more pricing power to property owners and operators, and you're not putting quite as much stress on the residents as you push rents. So that's kind of a good news, bad news chart there in terms of what's happening in the overall situation. Another thing I wanted to hit on is, as we move ahead, we do think that our base case scenario does call for an economic slowdown that really sort of kicks in 2020, last half of 2020 and on into early 2021. I think most economists are forecasting a mild recession at some point within the next 5 years. They don't necessarily agree on the exact timing, but that's when we have plugged it in. And when I say recession, don't be super scared of that, because we're not talking about a repeat of 2008, 2009. We're talking about mild recession where job growth goes down to basically to zero, and slightly negative for a couple of quarters. The comparison point in 2008, 2009, we lost 11 million jobs in the US. This is a very different sort of situation. So, and a much milder impact is what we're incorporating into the base case scenario. Another thing that gets a lot of media attention is what happens with the homeownership rate. And you can see that homeownership bottomed in 2016 or so, and then has been moving up a little bit. The number for first quarter of this year actually came down a little bit again, but in general, there is a little bit of an upward trend there. So you are starting to, as we talk to our clients, they do confirm that they are starting to lose a few more renters to single family home purchase than they have in the past. Varies by market. It's certainly not happening out here in the Bay Area where renters cannot afford to buy in most cases. But there is a little bit of an uptick there. And some media have a tendency to portray that as a real problem for the apartment sector moving forward. And my opinion on that would be no. People move for a lot of different reasons. To buy homes, certainly a factor in some places, but much more important is they move for when they change jobs, they move when they change household status. So if I'm owning and operating an apartment, I don't care why you move, I care whether or not you're gonna move. And so let's talk about resident retention when a lease comes up for renewal. And this is one of these, I'm not aware that anybody else in the country can actually track this metric that RealPage can, pulling it out of the technology systems. So you have an existing apartment lease, it comes up for renewal. Do you stay or do you go? And you can see how that has tracked over the past few years. I'll point out that this is a 4-quarter average on resident retention, and we're looking specifically at the top 50 markets where you've got lots and lots of data on this. And you can see in first quarter, 53% of the leases that came up for renewal in the trailing 12 months ended up being renewed, and those folks stayed in place. And so you had a little bit of an earlier conversation about pay attention to that. You want to hold on to your residents. Turn cost is a big deal. The apartment industry is doing great in that category. So I don't care if a handful of people, more people are going out to buy homes. More and more people are choosing to stay when leases come up for renewal. And that's, again, as we talk to our clients, we preach that over and over. Pay attention to what's happening to your resident retention numbers and pay attention to what is happening on your renewal lease pricing versus what you're charging the new person walking in the front door for the first time. And I'll talk about that point a little bit later. All right, so there's the demand story. Let's talk about building activity. There is a lot of construction that's going on, even here in the Bay Area, which is not a super aggressive building market by national standards. You do see significant numbers of cranes with apartment buildings going up. Every year, we'll get quizzed. Paul, you mentioned the NMHC National Conference. That's always a part of the discussion, and that occurs right in January every year. And there's always a debate on how many starts are we going to have in a given year. And economists like me every year will stand up there and say, each deal is a little bit harder to do than the last one. So we think we've reached the peak in starts, and it's going to begin to slow down a little bit. And then year after year after year in this cycle, we're wrong. At this point, I think we're going to have to see a disruption to capital flow to get a slowdown in starts, because, hey, if somebody's going to give a developer money, I spent the first 10, 15 years of my career doing analysis of new development. If somebody's giving a developer money, they're developing regardless of what the market conditions say. So right now there are around 400,000 market rate units under construction across the country. Here's what we can show you on the delivery pace, and you can see in recent years, after a big slowdown during the recession, we ramped it back up, and then in the past few years have been delivering about 300,000 units a year. What did I just tell you demand was? It's about 300,000 units a year. So it's been very steady. Looking at that blue area of the chart, which is our forecast, you can see that scheduled deliveries go up a little bit over the next few quarters, and then by our count come down. However, what we're seeing in this cycle, it's tough to get the labor to get the project over the finish line. And so whatever is scheduled to come online, a little bit less than that actually does. So that part of the blue area that spikes a little bit above 300,000 units, I would say just shave that off and push it forward a little bit, which would say for the next 2 years, then probably we're going to continue to deliver about 300,000 units across the country. But there are huge differences from one place to another in terms of where that building is occurring. And developers, there are about 15 metros developers really like, and those 15 markets have accounted for a little bit more than half of total construction in this cycle. And so the Dallas crew here, we're nuts in Dallas in terms of how much we want to build. And we have 37,000 units under construction in Dallas-Fort Worth at this point, about 30,000 of those being in metropolitan Dallas and only about 7,000 of them being in Metro Fort Worth. We'll make this available to you. You can, I'm not going to go through everywhere on the list. I'll point out Bay Area is not on that list, but because we treat each one of the we treat San Francisco, San Jose, and Oakland separately because they don't necessarily move together the way that, for example, Dallas and Fort Worth do. If you put those 3 metros together, certainly the Bay Area would be on the list, but viewing them separately, it's not especially aggressive. All right, so talked about demand, I've talked about supply. Let's put that together. What does that tell you about occupancy? And our takeaway there is that certainly occupancy is tight, and it's tight enough that we don't think that there's really significant overbuilding that's occurring in this cycle. Certainly not on the metro level. When you get down to individual submarkets and neighborhoods, sometimes there is a little bit, the numbers are a little bit aggressive. We've got first quarter of this year, the occupancy rate is a little bit north of 95% among stabilized properties, and that means that you've actually basically, if it's a new project, you've basically got it through that initial lease-up process. So that's certainly a very healthy number, and there's a history to give you some perspective. So for the past few years, we've been running a little bit north of 95%. Again, 95.2 right now. Let's back it up a couple of quarters. Fall of last year, we were pushing at 96%, so we have backed off a tiny bit, but that's still a really solid number. A big part of the story of why this occupancy has done so well in this cycle is what's happened in Class C products, so the lower end of the price spectrum. I've got occupancy for that product niche in the dark blue line there, and you can see that there's been a history for Class C to underperform on occupancy, but a few years ago, Class C caught up, and then the last 2-3 years, actually the tightest occupancy has been in that Class C product. From our perspective, what really happened there is rent growth has been so substantial in this cycle, including in the Class B product, so that middle tier bread and butter product, that some people have been priced out of that middle tier, and now all they can afford is the bottom end of the product sector. You really see that all across the country, but it's especially pronounced in the Sun Belt markets, which traditionally would have had pretty significant vacancy in Class C product, but now it's pretty tight all across the Sun Belt for that bottom tier product. So what does all that tell us about what's happening for rents? And again, it's late cycle. We think we're past the peak in terms of rent growth, but rents are still moving upward. And looking at the long-term story, they're moving upward at a pretty decent pace. For the course of this cycle, rents are up about a third in the nation as a whole. That is pretty substantial. I think that you are not going to be shocked when I tell you that the fastest rent growth has been here in the Bay Area, and that prices here are up about 50% versus 33% for the nation as a whole. At the next tier of performance, it's around 40% or so in places like Seattle and Denver, and move over to some of the southeastern US markets have had rent growth in that range. So as of first quarter, we have rents going up a little bit north of 3% on an annual basis. And here's the perspective of the cycle as a whole. My first thing that I would point out as we look at the last half of that chart there is look how long rents have been climbing. 8 full years of annual rent growth, certainly the longest stretch that we've ever seen for that, and that typical annual rent growth has been close to 4% in that time period. So look, again, toward the end there, we had peaked at annual rent growth a little bit north of 5% back in 2015. We gradually slowed down to around 2.5% rent growth. It looked like it was stabilizing there, and then a little bit of a surprise in late 2018, and then the beginning of this year, that number ticked back up a little bit to above 3% again. And looking at performance by product segment tells that story. And what had happened previously was, as we were delivering all this new luxury product, rent growth at the top end of the market had slowed to 1.5% to 2%. But then suddenly, toward the end of last year, rent growth in those luxury properties regained some momentum and went back up to 3% or so, which is what we were seeing in the nation as a whole. That really, in that luxury segment, reflects that we had a little bit better burn off of leasing concessions that had been offered whenever the properties, where you were trying to build that initial resident base. And so you gained a little bit of pricing power in year 2 on those types of properties. I do think that this relationship, while they're all about the same now, as we move forward, there's going to be a tendency for them to move in different directions. Again, lots more new supply coming. It's going to be tough for Class A product to continue to have rent growth of 3% or more. Class B is probably going to be the best positioned space for rent growth. And then Class C, I think there is some vulnerability to affordability challenges among the folks who live in those Class C properties. And as I say that, I'm going to point out that that's a different scenario than has played out in past economic cycles. And institutional money, which really likes that Class A luxury product, would maybe disagree with that positioning. But what I think is different in this cycle, in the previous cycles, you wanted to be in Class A product during a downturn, and that was usually referred to as flight to quality. And the assumption was, if the market softens, you can cut your rents a little bit at Class A properties, and people who live in Class B developments will move up into that higher quality product. But during the course of this cycle, Class A product has gotten really, really expensive. And so the nationally, the average difference between in monthly rent for a Class A project versus a Class B project is about $500. You would have to really cut your luxury rents to reach it to a level where people living in Class B product could move up there. And that's different from one market to another. Here, the Bay Area, the difference between Class A and Class B is huge. It's much more than that $500 number. I think the metro with the least premium is Las Vegas, and it's only about $200 more to rent a Class A unit than a Class B unit in that one. So it's going to be different depending on what metro you're in. But again, we think that probably the best rent growth as we move forward is going to be in that Class B segment. There are some places across the country where owners and operators tend to give away a lot of rent, and there are some places where that's not typical. For the U.S. average, and again, looking at stabilized communities, about 17% of the product has some sort of free rent giveaway for new folks walking in the front door. Houston and San Antonio, and it's not just now, it's just always. That's the way those markets work. Nod your head, the Texas people. I mean, they like to discount in those two spots, and so the concessions never seem to go away. There's some perspective on other places, and you can see it's not the really expensive markets. It's more middle to bottom tier markets where you tend to get a little bit of discounting. And again, we've said that there was some momentum in the rent growth pace late last year that showed up in some metros more than others. There's a list of the markets that really had the most momentum in terms of just improving the performance relative to where they were a bit earlier. That included Austin, Phoenix, and some surprises. Like I can't really explain to you why Memphis is gaining a lot of momentum and Greensboro is moving up the list. But it's an interesting array of markets there. So let's then talk about just in general, where do the markets across the country stand in terms of pushing rents? And Phoenix and Las Vegas have really broken away from the pack. And for new resident leases, prices are going up around 8%. And then you have an assortment of markets where you've got 4 to 5% rent growth. Again, keeping in mind that the U.S. number overall is around 3%. More and more, we're getting questions from our clients about small markets. They're struggling to find deals that have good returns in the big markets. So they're chasing that yield and looking at some smaller markets. So we've given you a list of some small markets that seem to have a lot of rent momentum there. But you do have to be careful in small markets. They are vulnerable to some volatility. It doesn't take much to overbuild them. And then sometimes they're really dependent on one economic sector. And Exhibit A is right there at the top of the list. Midland, Odessa, that is the West Texas oil patch. And so if suddenly oil prices take a dive, those are great numbers right now, but a couple of years ago in Midland, Odessa, the number would have been minus 30%. So it can really move around. All right, so I talked earlier about, hey, you want to hang on to your existing residents to avoid the turnover costs, but you also right now want to hold on to them because you're actually getting a bigger rent bump for a renewal lease than you are for the size of the rent bump for a new resident moving in. And across the country right now, the average renewal lease price increase is about 4.5%. And I told you for the new resident number, it was 3 to 3.5%. So again, people are staying in place and they're actually willing to pay more to stay in place to avoid the movement. let's talk a little bit about capital flow and what that is doing to pricing. There's a lot of capital out there that is after these multifamily deals, and you do have to realize that that's happening. For property transaction information, we partner with a company called Real Capital Analytics, which we feel has the best data on that front. So for the US, annual sales of multifamily properties, it's about $200 billion of product that has been trading hands on an annual basis, and we've been holding at that level for several years now. And that certainly is pushing up pricing. On a national basis, the typical price per door is running around $161,000. Anyone has bought a Bay Area property, you're laughing at that number because that is just giving it away. But so let's do, we'll circle back and look how that varies by area, but let's look at cap rates. So cap rates have slowed down to 5.5%. It's interesting. There was certainly every year whenever we tell you at these national events that the number of starts will come down, we also will tell you that this is the year that we hit the inflection in cap rates and that they'll start to go up a little bit, and that never happens either. So again, lots of money chasing these deals. And then I thought this would be an interesting perspective for you guys is look at typical price per unit across the country and how much it varies. So here in the Bay Area, typical price per unit is north of $400,000. Paul, over in our neck of the woods in Dallas, $135,000 a door. And you can certainly see as we move over into the southeast part of the country, again, those are certainly much more it's easier to make the deal. The money goes farther over there than it does anywhere on the West Coast. And then looking at the East Coast, certainly New York and Boston are out of reach for a lot of folks as well. So let me conclude with what we think will be happening over the course of the next couple of years. And so we think that this year, it's really, by and large, more of the same of what we're seeing right now. Our overall U.S. occupancy forecast is around 95%, basically where it is now. Our U.S. outlook for rent growth through the end of the year, around 3%, basically where it is now. Top tier performers, by and large, not moving much from where they are right now. Las Vegas and Phoenix with the premium. And then we think the next tier of markets includes places like Atlanta, Salt Lake City, Boston, San Diego. All right, so we go to 2020, again, in our forecast, with the economy slowing down. As that happens, that shuffles the list a little bit. And so I'll point out, even if you don't think the recession is coming in 2020, anticipate it's coming at some point over the course of the next few years. And whenever that happens, the ranks of the markets will move around a little bit. Our forecast is that the economy holds up better in Texas and the Carolinas than it does in the rest of the country. And so, for example, looking at that, then you're going to have stronger employment growth relative to other spots in Texas. And the one place in Texas where we're not building off the charts is Fort Worth. And so then Fort Worth actually briefly, in our analysis, moves to the #1 position for overall performance. We would also expect pretty good performance relative to the rest of the country in Boston, here in San Jose, or here in the Bay Area, particularly in San Jose, Anaheim, San Diego, and Providence, Rhode Island are at the top of our list. And also let me point out, when we say a slowdown, note that we said that U.S. rent growth runs around 2% in that lull period. We didn't say there are rent cuts coming. We said that the growth rate slows down from 3% or so to around 2%. And there certainly will be some spots on a metro level where you get down to close to zero, and there would be certain neighborhoods where you would actually go negative. But still, overall, this is a reasonably healthy outlook for one of those economic slowdown periods. So I've thrown a lot at you there, but I am actually happy to talk about whatever you want to talk about.